invest in what you know. It's a simple idiom, but I think it's a good discipline. If you don't understand something, you don't have confidence in it and who's behind it, just don't do it, right? And there's plenty of things out there, plenty of options out there.
Welcome to Multifamily Insights. I'm your host, John Casman, and I want to thank you for joining us for another great episode. Listen, if this is your first time listening to the show, welcome. Make sure you hit that subscribe button so you don't miss an episode. And if you're an avid listener to this show, we need a little bit of help from you, right? Leave us a rating and review. We want to get your honest feedback of the show, but also anything you'd like to see so we can make the show work harder for your investing goals. Now, today we've got a great guest. We've got Mr. Ben Fraser. They say you're the average of the 5 people you spend the most time with. So if you want to grow as a multifamily investor, you have to spend more time with other multifamily investors. And an easy way to do that is to join our apartment investing mastermind group today. Just go to casmancapital.com and click on the mastermind button. Now, as a part of this group, you'll get access to expert trainings, group coaching calls, industry news and updates, as well as all of our webinars and workshops, including our 3-hour workshop on raising capital. Again, if you want to be around other multifamily investors that can help you scale your portfolio today and grow your network, make sure you're a part of the Apartment Investing Mastermind. Just go to casmancapital.com and click on the Mastermind button today. Ben Fraser is the Chief Investment Officer at Aspen Funds, where he combines his analytical nature with a passion for delivering outstanding client service and strong returns. Ben is also the co-host of Invest Like a Billionaire podcast, where he joins his father, Robert, the co-founder and CFO of Aspen Funds, along with co-founder Jim Mafuscio, to discuss economic trends and best practices for alternative investing. Let's welcome to the show, Ben Fraser.
Hey, thanks for having me, John. Looking forward to it, man.
Absolutely. Hey, Ben, I went over your bio at a very high level. Why don't you take 2 minutes and fill in some of those gaps?
Yeah, sure. So you said I'm a chief investment officer at Aspen Funds, and been in that role for a little bit. Really love what we get to do. So Aspen Funds is a private equity firm. We focus on a few different verticals, a lot that your listeners are probably familiar with in the real estate space. Multifamily, industrial, and we actually started in the debt side of things about 10 years ago. We started doing mortgage note funds and have since branched into commercial debt. And then also outside of real estate, we're big investors in oil and gas. And our approach is different than a lot of operators in that we call macro driven alternative investing, where we look first at the big picture trends, where do we think the opportunities are going to be, and understand the macro picture to then determine what the investing thesis is going to be going forward to get those best risk adjusted returns. So gives us some agility, gives us the ability to kind of find and pick and choose, best opportunities, and then we invest in every deal we do. So part of it is our own way to deploy our personal capital, almost like a family office, and that's kind of our structure. My background actually was a commercial banker by background. Spent several years in commercial banking. I was an underwriter, an analyst, and a lender for many years, and learned a lot in kind of the debt side of things. Learned how to evaluate risk, right? As banks, they don't get any upside, they only get the downside, right? And so you're kind of trained to, in some senses, look at things glass half empty. And so it can be, you know, not fun in that scenario, but it's a really good training ground. And then about 6, 7 years ago, I moved over into the private equity side. And for me, it was really kind of a light bulb moment as I was a banker. One of the cool things I got to do is go under the hood of a lot of these wealthy borrowers of the bank, and their focus was business owners, entrepreneurs. And so, a common thread that I saw is I'm looking at their personal financial statements. Right, they have to send it to me as part of our underwriting, and I get to see exactly what they own and how did they get to where they are, and the kind of two common themes that I eventually kind of had a light bulb moment of similarities between the successful entrepreneurs was, one, they're business owners, and two, they invested a lot in real estate. And so I thought, hey, I want to be successful. I want to build my own wealth, and so it's a clear path for me to kind of come over to the more fun world of investing in equity investing, and looking for opportunities and building a business. And so that's kind of the shorthand version, but it's been a fun journey.
I love it, man. You talked about that background in banking and, being an underwriter, being an analyst, being a lender, and being close to some of these high net worth individuals who are coming in and sending you kind of their financial statements and you recognize, man, a lot of people seem to own businesses and have investments in real estate who seem to be doing really well. Maybe that's where I should be playing a little bit more. Let's talk a little bit more about Aspen Funds because you said your company's been running for about 10 years. You've joined around 5, 6 years ago. And the thing you said that jumped out to me was while you do multifamily, you do, different asset classes, you're also like oil and gas and some other things. And you take more of a macro driven approach to alternative investments. Can you elaborate a little bit more on that and maybe how that differs from maybe groups that only focus on multifamily or only focus on a specific asset class?
Yeah, absolutely. It really stems from, our other partners' long time experience of investing in real estate, but also in private equity and in non-real estate asset classes, like venture capital, real estate hedge funds. And so we have a very broad set of experience on our team. So we have four partners. I'm one of four. I'm the youngest of by probably 20 to 25 years of my other partners. And so they bring a lot of the kind of gray-haired experience to the table. And what they've experienced and kind of their thesis is cycles really matter, right? And the timing of where you're at in the cycle for your investing strategy is probably the single most impactful driver of your future returns, more so than picking one asset class and say vertically integrating, very, very deep in one. And there's some merits to that approach, absolutely, right? Because you do get some efficiencies, you do understand a market really well. But what we found, right, is if you're in a market that's at a macro level going down, it doesn't matter how good or how much you can get 5% cost savings on your expenses. The overall picture of that is not in a great position, right? So our thesis is the best way to maximize returns is to actually be positioned where the best opportunities are versus being deep in just one area, right? There's different opinions on that, and I understand that, but that's really our approach and really why we've created a more agile business model to where we can shift to the market of where we think the opportunities are. And I think a great case in point is where we sit right now at the beginning of 2024. Last year, we saw the fastest interest rate increases that we've ever seen in history. And that has fundamentally changed the game for a lot of real estate asset classes, how you're underwriting, what matters, and ultimately values, right? And there's still been this big price discovery period that we're still in the middle of. And things have shifted and you have to be agile. And if you don't have an agile business model, you might just keep doing the same things you've been doing, but it might not be the best thing to be doing, right? And so that's really the approach and why we take a more high level approach, evaluate the landscape, really like a big capital allocator, right? Like a family office. They're looking at where are the different opportunities and how do we allocate capital and build the best partnerships and teams in those verticals to be successful.
I like how you talked about being able to look at the macro economy and being able to make decisions based on where the opportunities are and using interest rates in 2023, the interest rate climbs as an example there. Are there specific metrics you look at to say, hey, here's where the macroeconomy is going. This is where we need to be focused on now? And how do you make sure that you're not investing in something that is cyclical, right? So I know we talk about certain things, but when we talk about those cycles, I mean, you want to be exiting at the right times as well. So just talk to me a little bit more high level about, the way you look at that metrics and maybe how you kind of look at timing the market.
Yeah, yeah. I'm glad you asked. Like that's where most people kind of go. It's like, are you market timers, right? That's kind of probably the first question. And the answer is emphatically no, right? We're not trying to time markets, right? And so when I say timing matters, I'm not saying market timing matters because that's very difficult to do, right? Especially in private markets where there's a lot less liquidity and there's some kind of good general times to be buying and selling, but it is more difficult to do it. What we really focus on are what we call megatrends, right? So we kind of differentiate between we call the kind of tides and the waves, right? The waves are what the market's doing in any given shorter time period, over a week, over a month, over even a year. What we're looking at are what we call megatrends. These are long-term trends that we believe the fundamental economic support is behind and supporting for at least another decade, right? And so within that decade time period, there's going to be some part of the cycle movement, but generally the trajectory is going to be upward. And if we can be in a kind of tailwind environment, in an environment where the fundamental support is creating a tide, right? Whereas you can't really go against the tide. Um, that creates a lot more opportunity. It creates a lot more margin, right? If you're in an inflationary environment, you want to be investing with inflation, not against inflation, right? And these are just basic concepts people understand, but a lot of times they're not actually doing it, right? Or they're not actually positioned for what are these tides that are going to be here. So I mentioned inflation. That is one of our megatrends. We have a whole presentation. We have 7 megatrends that we've identified that we do kind of updates on regularly and kind of helping put that information in front of people to understand, where do we think these things are going, right? And we actually think inflation is going to be around for a while. And we've been saying that for the past 2 years. And look, it's gone down a lot, but it's been pretty sticky. It's right now about 4%. That's still 100% higher than what the Federal Reserve wants. So that's going to impact interest rate policy and really the next several years of um, how that kind of plays out in the market. So if you think that's the case, you're going to invest differently than if you think interest rates are going to drop by half in the next couple quarters, right? So those are the reasons why we focus on longer term trends, because directionally you can generally have a good sense of where something's going. You may not know the exact timing, right? Oil and gas is a great example. A pretty volatile commodity based investment, right? And some people don't like that. But there's fundamental long-term reasons why we really like that asset class that we think are going to prove out over a 10-year time period. I don't know exactly when, but I'm pretty confident over 10 years those themes will play out.
I appreciate the context of the way you look at the mega trends and not necessarily timing the market, but really focusing on where the mega trends going and how do we make sure that those trends are in our favor when we're making investment decisions. You talked about inflation being one of the 7 mega trends that you've identified and using that as a tool to help you identify your investing thesis. Are there other mega trends that, from a macro investing standpoint, people should be aware of, or I'm not sure how much you can share on the 7 trends you've already identified, but this sounds like a really interesting place.
Yeah, I mean, we can get into it for sure. That's I would encourage people if they are interested to, maybe go check out the webinar. We have a recorded webinar you can watch and see that. But yeah, at the end of the day, inflation's kind of this 800-pound gorilla, and 4% doesn't sound that high, right? But on the whole of the GDP, which is a very, very large number, this is a very impactful tide that you got to ride with, right? You want to be in something that can inflation adjust. Real estate generally is a good place to be when there is inflation, but there's certain asset classes that perform better in inflationary environments than others. And the kind of unique thing we have when you have higher inflation, you generally have higher interest rates, right? Because the Fed is trying to stymie some of that growth, slow down some of the growth, so inflation doesn't get out of control. We have hyperinflation and other things that could be even worse. And so a lot of times higher interest rates can impact valuations. But if your investment time frame is long enough, and you can put together a really good capital stack with maybe it's more expensive debt now, but you have a really good path to stabilization. You got great cash flow. You can really ride out a lot of those bumps and get the advantage of inflation over time. Another part of the megatrends and how it kind of plays together with inflation is you know, one, we have to understand why we think inflation is going to be higher for longer. And we think it's really driven by two things, which have been in place since really the past several years. We've started seeing inflation tick up pretty significantly. One of them is labor shortages, right? We've seen persistent low unemployment for the past 2 years. And a lot of people are scratching their heads, because we have these mixed signals from the economy, but we continue to have like record low unemployment. And record wage growth and really really strong job market, and that's kind of confusing for some people. But what happened is kind of this post-COVID era, COVID actually accelerated a lot of these things that were already kind of happening, but kind of forced the hand of people that were, say, at retirement age or kind of close to it. There was a lot of incentives to kind of retire early. A lot of people left the workforce, during the COVID era, and they haven't come back. And then what's happened is we have this mismatch of we have actually way more job openings than we have workers ready to fill them. And the gap is in skilled labor, right? Because a lot of the signs we see out on the doors of all the restaurants we drive by of now hiring, paying now $18 an hour for, a burger flipper. There's not enough um, workers in general, but especially actually in the skilled labor, which are more college educated jobs, engineering jobs, professional services, those kind of things. There's a huge shortage, and there's not really a clear path to fill those as we're currently going. So that's going to continue to put pressure on wages as wages go up. That's very inflationary. Consumer spending is the largest portion of GDP, right? Makes up the largest portion, about 70%. So if you have strong wages, you have people making real income, they spend that. It's going to drive GDP growth, which is inflationary. The other big part of it is energy prices, and so we're actually seeing right now kind of subdued energy prices, but it's been higher than long-term averages, and then it pops every once in a while. And what's happening is there's a long-term lack of supply, not only domestically but internationally, due to a significant pullback of drilling and new production and exploration for new production. And so, not to get into all of this, but this is probably a whole other podcast because this kind of forms a thesis for we like oil and gas. But ultimately, oil and gas is an interesting asset class because it's a depleting resource, right? Real estate generally goes up over time; it appreciates. Uh, Commodities like oil and gas naturally depreciate or deplete. And as you're pulling it out of the ground, there's less of it there. And so there's less reserves, becomes less valuable. And so to just maintain current production, we have to replace somewhere between 5 and 10% of our production in new drilling every single year just to maintain the kind of status quo. We haven't done that. The funding of new drilling has dropped by over 50% over the past 7 years. And a lot is being driven by policy, right? The ESG standards that are being forced on a lot of these big capital allocators and a lot of the risk slaps that, the producers have had. And so from our standpoint, not getting into politics at all, from a just pure economic and investment standpoint, those are really, really good dynamics where, you have limited supply. It's very inelastic, meaning you can't just flip a switch and all of a sudden start generating more supply, right? It's takes many, many years to build this out. And by most estimates, even the most conservative, left-leaning, climate-leaning estimates, demand for oil is actually projected to stay the same, if not increase, over the next 10 to 15 years, as we're kind of in this weird transitionary period. So again, that's going to be very inflationary because higher energy prices kind of are, a tide that lifts all boats, right? Energy is not necessarily in CPI explicitly, but it increases the prices of everything across the board because energy is kind of the mother of all of the lifeblood of a lot of our supply chain of how things are moved, shipped, transported, produced, et cetera.
Ben, I appreciate that, man. Great explanation on the mega trends and, why you're focused on the energy sector and the way inflation impacts, the economy and the labor shortage as well. So we'll definitely link to that webinar you put together on the mega trends and what to look out for. You started talking about, labor shortage and inflation and the interest rates. And I know one of the things that your group, the Aspen Funds, are focused on is the lending side. Going back
Mhm.
to kind of where you started, and in particular, you're big on private credit. Can you explain exactly what that means and why you think there's an opportunity there?
Yeah, absolutely. So, like you mentioned, we've been operating debt funds for over a decade. That was actually kind of the first, fund that Aspen started with was a kind of distressed debt fund coming out of the last cycle, the last, great financial crisis started in 2012, and has had a great run on the kind of residential side. What we're kind of seeing is a um, similar situation playing out in the commercial real estate side, right? And we don't think it's going to be as dramatic as the '08 crash for a variety of reasons. We're much healthier as an economy relative to that last time period, but there is a lot of headwinds facing commercial real estate right now, especially office and multifamily, right? But it's going to impact the asset class is differently based on the markets, based on supply, but the real reason is interest rates, right? And we all kind of intuitively understand, interest rates going up, that impacts the value negatively, right? Because that impacts your cap rates. Higher cap rates mean lower prices. And you have to kind of trade at higher cap rates to be in a positive leverage scenario, which means your borrowing costs aren't exceeding your unlevered cash flow, right? That's not a good place to be. And so we're in this weird situation where interest rates have increased by, 500%, at least the kind of Fed funds rate. Borrowing costs have increased probably, 100%, 125%. Um, and a lot of deals by a lot of reports, these are coming out. Newmark just put out an amazing report just recently, a few months ago, on this kind of, impending crisis in commercial debt. What's happening is, well, let me rewind the clock a few years, right? Because what happened in the kind of 2020 to 2022 era, we all kind of rewind the clock and remember, wow, real estate's on fire. We have this crazy rent growth happening. Everyone's trying to get into real estate. We had all this money being pumped into the economy, so everyone's trying to invest. It's, bidding wars on these assets. Cap rates are being driven down because of the demand. Borrowing costs are super, super low. And then we had this kind of advent of what I'll call a syndicator bubble, right? Where everyone and their mom decided that they could raise capital and go buy real estate because it just goes up and it's pretty easy to do and I'm making all this money. And what happened is a large portion of the market for the debt of doing these kind of syndication, these value add, plays was bridge debt, private bridge debt. This is non-bank lending. It's very attractive because very high leverage points and non-recourse generally. So they can get, 80 to 90% leverage. So very low down payment. You don't have to raise as much equity. Um, and non-recourse. So you don't have to sign a personal guarantee except for, fraudulent acts. That's very attractive. But the challenge and the trade-off was floating interest rates. And no one really thought a couple of years ago the interest rate risk that we have now seen in the market was even a possibility. Well, we all know what happened, right? Interest rates increased by, the fastest they've ever increased. All of a sudden, these deals that were extremely highly leveraged, their debt service costs have gone up massively. Meanwhile, the market is not only values have come down because of the interest rates, but it's very challenging environment, especially in a lot of coastal southern markets, Sunbelt markets, where we are seeing rent growth declines, right? Rent deceleration, actually dropping rents because there's a massive amount of supply. We've actually seen the most supply hit the market starting last quarter and going through the rest of 2024 that we've ever seen in the U.S. And it's not just by a little bit; it's by a lot bit, right? Like a 60% increase of the next highest, level of deliveries is hitting the market. So all this new supply is going to put a lot of downward pressure on rents. Meanwhile, we're seeing, very, very high increases in operational costs. Insurance costs are going through the roof. All these property tax readjustments are hitting people. So you have this kind of perfect storm, I'll call it, of, floating rate debt going up, top line revenue going down, expenses going up. All those things are squeezing margin. And then the other kind of gotcha on a lot of this bridge debt were shorter term maturities. They generally had 3-year maturities. So you had to complete your business plan and really probably sell within 3 years to not get stuck in a difficult scenario. And so a lot of these maturities that originated 3 years ago are starting to hit. And so we're just starting to see that hit the market right now by a lot of estimates. Somewhere between 25 to 30% of properties that have, maturing debt will not qualify for a refinance due to low NOI, due to NOI that is not hitting the targets it needs to hit to get refinanced and pay off all the debt. So what's that going to do? That's going to put a lot of pressure in the multifamily market for the next, really, we think 18 to 24 months. And we take the opportunity now. So I set the stage probably too long, but I love these kind of things, right? So the opportunity is as banks have pulled back, right? Their leverage rates are going way down. They're kind of going risk on. We don't want to put more credit out to new borrowers. We got to make sure our portfolio performs. We're extending, our maturities to try to kick the can down the road. Equity is really hard to raise right now because investors are seeing a lot of deals that aren't performing well. They're getting wiped on certain deals. I know a lot of operators that are in that position where they're just trying to recover the equity that was put into the deals, right? That's a reality that a lot of people are going to have to expect this year. So you have this gap, right? But now things are starting to settle a little bit where the price discovery is happening. Prices have come down a little bit. We're actually seeing positive leverage, good cap rates, better cap rates, I'll say. And so what we're seeing is being able to come in at a lower part of the capital stack. So private credit just basically means non-bank credit, right? So it's generally structured as mezzanine debt. So debt that sits behind the senior lender, or preferred equity, that sits before the common equity. And so you can come in, and what is interesting is, last money in kind of dictates all the terms, right? So if the property is in a good location, got a good business plan, but they ran short of their funding for their renovations. They have an interest rate cap they got to purchase to. They have a maturing interest rate cap that they need to purchase another one to limit their interest rate exposure. They just need to replenish reserves, right? A lot of lenders are requiring increased reserves. There's really good opportunities that can't get the funding right now. So we can come in with, pretty expensive money, but lower in the capital stack than the common equity, and very protective. LTV is probably around 70, maybe 75% all in. And so theoretically, the value of the property could still drop 30%, and your capital is still 100% intact. And so you kind of get, we're saying, equity-like returns with debt-like risk. And we think this opportunity is going to be available for the next several years as a lot of these deals start to cycle through the market. So that's a real big focus in 2024 is, building that vertical of our business.
I love it, man. You gave a lot of really good information. So I really implore everyone to maybe rewind that back a couple minutes and listen to that again. Some of it may take a second to digest, but I'm going to play back a little bit of what I heard you say. One, you talked about just the overall market right now, skilled labor, there being a gap in skilled labor. Really, when you think about the private credit space, I love the number you got into. You said 25 to 30% of the loans that are out there with expiring debt um, are not in a position to qualify for refinancing. And to add a little color to that, part of the reason, if you think about what Ben said, a lot of those loans were using high leverage. So think 75 is not that bad, especially back then, but think 80% or more
Yeah.
on the leverage. And what's happening now is most lenders are wanting to cap you at 60%
Yeah.
LTV. So if your income actually went down, if your expenses actually went up, it is virtually impossible to then use less leverage to actually wipe out that existing loan, which is why you're having to bring more capital. And what people are doing is a cash in refi instead of a cash out refi, because they need to
Right.
actually bring in money to actually wipe out that existing loan. So what you're talking about here in the private credit space is being able to identify opportunities that make sense. And I like the way you talked about it with, finding opportunities that have equity like returns with debt like risk. Can you give us an example of what that looks like? Again, I think that's a lot of information for someone to process. What may help is just walk through maybe an example of that. Because you're talking about existing deals. Someone already owns this asset right now. They wanted to refinance. Maybe it's not a position, or you talking about brand new deal that someone just got under contract. Maybe just give me an example of what you're thinking there.
Yeah, I mean, it's really both actually,
Okay.
because the capital markets are difficult regardless of whether it's an existing deal you're trying to just, make it
Yeah.
through and refinance, or new acquisition, right? Because we're seeing some actually like really good deals right now, but I'm still in the position where I want to go take the equity risk right now because I think it's the market's not rewarding you for that. But I could come in, as a preferred equity lender and still, charge an all-in rate of, 14, 15, 16, sometimes 18 to 20% all in, and be lower on the capital stack, be first preferential payment out, and still get the upside. But not have to take the big swings and kind of fill that gap. Because to your point, lenders that were, say, the 75 to 80% range are now in the kind of 60 to 65% range, leaving a pretty big gap, right? And especially right now where it's very difficult to raise equity, we can come in on new deals and bring that deal up to, say, a 70 or 75% all in leverage deal. So it's still not over leveraged, but it's a much smaller down payment that they got to go raise from the equity. And the deal, generally preferred equity is still accretive to the equity investors because they can potentially, if they hit all their metrics and time it right, can still make more. So from my standpoint, you're reducing your risk by being lower in the capital stack. You're the first to get paid out. You have a much lower bar to hit of values. Um, of if the value of the property drops, you're not getting impacted in your capital until that drops pretty significantly. Um, and you're the first money to get paid out, and you're still getting rewarded by the market from a pretty high return standpoint. So that's where we like it for just an opportunity, and I think it's going to be here for several years, just because I think it's going to be this kind of muddle through. We're going to see these pockets of deals that just start popping, and so it's going to keep a lot of downward pressure because I think investors get scared. But I think that's where a lot of opportunity is going to be created. So we're pretty bullish on that.
Ben, I love it. A lot of great information there. Ben, earlier you talked about real estate being a good investment for inflation. Can you explain why real estate is a good investment choice?
Yeah, absolutely. I mean, we all kind of get it intuitively, right? And if inflation just is the price of things going up, right, is the simple way to think about it. Generally, we've done a lot of historical correlations and analysis. Real estate is probably one of the best correlated asset classes to inflation rate, right? Because generally, what happens is as inflation goes up, you can increase, your revenue through the form of rent. So you can push that inflation through to your tenants, and that's generally accepted by the market, right? So in general, real estate has, say 2 to 4% rent growth annually in a normal market. In a higher inflationary environment, you could expect that to be on the higher end, if not a little bit higher than that, right? And so that's the great thing about real estate is on a long-term trend, it is very inflation protective. And if you think about the types of real estate that are going to be more beneficial to that are the ones that can change the rate of their rents the quickest, right? So the shortest term is, usually daily or monthly, which is like self storage. The next is, maybe housing, right? So residential or multifamily housing, you're going to usually have 12-month contracts. Probably squeeze in there too. Shorter term rentals like Airbnbs, vacation rentals, and then from there you have like retail, industrial, office that have longer term trends. But regardless, they're all going to benefit. But the ones that can adjust faster, you're going to get that benefit faster. So as it relates to like housing, because we've talked a lot about, a lot of the challenges facing multifamily, and we didn't get into office because it's such a different animal. But in the short term, we're seeing rent growth declines because we're having a lot of supply. But if you take a step back and look at the megatrends, we still have a housing shortage in a lot of markets, and there's a long-term projected trend where it's probably gonna be difficult for us to catch up to that shortage over time. So I still think that if you can buy right and you can hold for a long period of time, inflation will reward those that can. But in the short term, we are going to see some additional pressure being put on the housing real estate that we talked about, just earlier here. So I do want to clarify that because I think in general, it's a good place to be. But in the short term, if your time horizon is too short, you may not get rewarded for that. But I think over a longer time period, I'm thinking really between 4 to 7, 8 years is what I'm thinking. That's the time period you have to be going into a deal with to be able to get rewarded from the market for inflation.
If you want to learn more about this, I invite you to check out more at the website aspenfunds.us. Great information there. Ben, you also calls the Invest Like a Billionaire podcast. What can listeners expect when they check that show out?
Yeah, a lot of these kind of conversations, we're big on the macro conversation, doing a lot of economic content, and then our whole thesis is just training passive investors on how to level up their investing, right? How to invest like the billionaires and the big institutional investors, which generally have heavy allocations in private alternatives. But the cool thing is real estate is just one of about three primary verticals of private alternatives that the ultra wealthy are investing in, the others being private equity, venture capital, hedge funds. And so we talk kind of across the board on all these different kind of bigger topics. And so we can help hopefully educate people on different segments of the alternative investment space.
Well, listen, we'll make sure to put a link to that as well in our show notes. The Invest Like a Billionaire podcast, co-hosted by Ben Fraser. There been great information so far, but right now we're going to transition to our round of insights. Are you ready?
Let's do it.
All right, give me a failure or an apparent failure that sets you up for later success.
Oh man, the first thing that came to my mind was I did door-to-door sales back in college, and it was like the hardest summer of my life, working 75, 80 hours a week, all by myself, knocking on doors, just trying to sell these educational books. Um, Great sales training, just really hard time. And I did okay, but I didn't go anywhere near where I wanted to. But what it really set me up for was being able to push through challenges and one is build sales skills, which are invaluable in life. But um, I went way farther than I thought I could and kind of pushing myself, and it really set me up to be able to do a lot of things I'm doing now. With in real estate as an operator, there's a lot you got to navigate uncertainties. You don't always know what's going to happen, and as an entrepreneur in general, it's challenging, right? So you have to have that resilience and that grit to be able to go into that confidently and boldly and adjust as needed. So that was probably one of the biggest, failures, we'll say, but definitely helped me later in life.
Give me a digital or mobile resource you recommend for your business.
Oh man, it's semi-mobile. I just got these things called a Remarkable tablet. I love this thing. I don't know if you're familiar with them, but it's changing my life on keeping all my notes in one place. So it's basically just a tablet now. It's just for writing, journaling notes, all that kind of stuff. So I love it. Love it.
Give me the book you've recommended or gifted the most in the last year.
Probably 10x is easier than 2x. It's by Benjamin Hardy and Dan Sullivan. They wrote Who Not How and Gap in the Game. So some big hitter books. This is their newest one, and it's really good. It's really good if you're thinking about scaling and growing and really how to level up, right? Not getting this kind of incremental thinking that creates more effort, more just, trading time for money, but actually exponential kind of growth with actually working the same or less, right? And how do you do that? It's not that difficult. And so some of the frameworks and ideas have been so helpful for me and a lot of people I've talked with.
Give me a daily habit that helps you stay focused on your goals.
Trying to get up earlier than my kids, we'll say that. And I'm a man of faith, so trying to have time in the morning just to kind of center myself and just get ready for the day and just have that kind of quiet moment in the morning before the hustle and bustle starts really is a nice just daily habit to get going.
Give me your number one insight for successfully investing.
Yeah, I think it's kind of a simple idiom, but invest in what you know, right? And I don't think that means only invest in what you've done historically, but you can learn things now too. But don't invest in something you don't understand, people you don't know, and taking risks that you're not understanding what the risks are. Because I think that's where a lot of people get in trouble, and especially in alternatives and real estate. There's unfortunately bad actors out there, right? And you and I know some of these deals that have not gone well, and we're actually some were actually Ponzi schemes from the get-go. And I know a lot of people have lost a lot of money, and it's so devastating because you work so hard to earn your money, right? And I make the contention all the time, you should be working equally, if not more hard on learning how to invest and how to build and grow the wealth that you've generated through your income. So invest in what you know. It's a simple idiom, but I think it's a good discipline. If you don't understand something, you don't have confidence in it and who's behind it, just don't do it, right? And there's plenty of things out there, plenty of options out there.
All right, let's lighten the mood, right? You are out there in Kansas City. Give me your favorite place to grab a bite to eat.
Oh man, it's Kansas City Joe's Barbecue. Kansas City's Nova's Barbecue is my favorite place.
All right, sounds like a great choice there. I'm trying to think. I don't think I've ever been I know I haven't. I've never been to Kansas City, so I'm going to have to change that soon and get out there. I've got a lot of great people I know out there as well. So Kansas City Joe's Barbecue is a place we will put on the list. Ben, lots of great information. You talked about, just the approach you and your firm have taken, your background in banking and lending and recognizing that there's a lot of opportunity in business ownership and investing in real estate. I love your conversation on mega trends and understanding that you want to not so much time the market, but recognize which trends are driving the market moving forward
Mhm.
so you can hop on the right trends and not the waves, but really the tides so that you can have kind of the long term impact on the investments you're making. Recognizing the impact inflation has, interest rates, labor shortage, all these different things are critical if you're going to invest like a billionaire, right? You got to recognize where these opportunities are. Again, if folks want to learn more about you or your company, they can go to aspenfunds.us and they can also check out your Invest Like a Billionaire podcast. We'll make sure we put links to both in our show notes. Ben, thank you again for being a great guest and coming on Multifamily Insights. We look forward to staying in touch with you and hope you have a great day.
Thanks, Joe.